This is GSIQ. Quick note before we begin. There are channels copying formats, copying thumbnails, copying tone, selling memberships, courses, signals, private groups. That is not this channel. GSIQ sells nothing. Never has. Never will. Just raw data, public filings, exchange reports, and macro analysis you can verify yourself. If you're actually paying attention, drop GSIQ in the comments so I know you're here. Now, Tuesday evening, what happened in the silver market today is not about price alone. It's about structure. Because right now, we are watching something develop beneath the surface that most financial media is either ignoring or doesn't fully understand. Silver is not just moving. It is separating. And when I say separating, I mean geographically, structurally, and psychologically. Western spot markets opened relatively calm, trading within a tight intraday range. Nothing dramatic. Nothing that would trigger breaking banners. But while Western traders were watching that narrow band, something else was happening in Asia. The Shanghai Futures Exchange resumed full participation after holiday closures, and pricing behavior there diverged meaningfully from New York futures. The premium between physical-oriented pricing in Shanghai and futures-heavy pricing in New York widened again. This isn't new, but the magnitude matters. Over recent months, that premium has expanded well above historical averages. Historically, Shanghai silver trades within a small percentage band relative to COMEX pricing after adjusting for VAT, currency, and logistics. Recently, that spread has been materially elevated. That tells you something. Either Western futures are underpricing physical tightness, or domestic Chinese demand is outpacing export availability, or both. Now let's talk about structure. China remains one of the largest refiners and consumers of silver globally. Industrial demand, solar, electronics, EV components continues to absorb significant supply. When domestic policy shifts toward prioritizing internal consumption or tightening export licensing, global arbitrage becomes constrained. Add VAT friction, capital controls, import quotes, and logistical lag, and price equalization becomes slower and more inefficient. That's when spreads widen. That's when premiums persist. And when premiums persist, they signal stress. Now bring this back to COMEX. Registered silver inventories, the metals specifically available for delivery against futures contracts, has been trending lower over recent months. Not collapsing overnight. Not zero, but declining. Meanwhile, open interest in active delivery months continues to represent multiples of registered supply. That is not unusual in futures markets. Futures are leveraged instruments. Most contracts settle in cash or are rolled forward. But the coverage ratio matters psychologically, because when the ratio between paper claims and deliverable metal widens too far, confidence becomes the variable to watch. If confidence remains intact, the system functions. If confidence erodes, volatility follows. Now, layer on options markets. Implied volatility in silver-linked ETFs and futures options has been elevated relative to realized volatility. That means traders are pricing in the possibility of larger moves than the spot market has delivered recently. Historically, when implied volatility significantly exceeds realized volatility, one of two things happens. Either volatility collapses as fear dissipates, or price makes a decisive move to justify that premium. Calm markets with expensive options rarely stay calm forever. That tension is building. Now, macro. The Federal Reserve remains cautious. Inflation has cooled from peak levels, but remains sticky relative to target. Growth is positive, but uneven. The dollar index has softened compared to prior highs. Treasury yields fluctuate with every inflation print and Fed comment. Precious metals respond not only to inflation itself, but to real rates nominal yields minus inflation expectations. When real yields compress, metals tend to find support. When real yields rise, metals face pressure. The tug of war continues. Meanwhile, geopolitical tensions remain present in multiple regions. Trade policy uncertainty continues to inject unpredictability into currency markets. Central banks globally continue accumulating gold at historically elevated rates, signaling a long-term diversification trend away from exclusive dollar reliance. Silver, while more industrial than gold, benefits indirectly from the same monetary hedging flows during periods of uncertainty. Now let's address mining equities. Silver producers have reported improved margins during periods of elevated spot pricing. All-in sustaining costs for many major producers remain significantly below current market pricing levels. When margins expand, cash flow expands. When cash flow expands, balance sheets strengthen. But equity pricing often lags or overshoots underlying commodity assumptions. Analysts sometimes use conservative forward silver price assumptions in their valuation models. If spot pricing remains elevated longer than models assume, repricing can occur. But mining equities are leveraged instruments. They move both ways faster than the underlying metal. That cuts both directions. Now the bearish case, because ignoring it is irresponsible. Industrial demand can slow in a global recession. Solar installations, electronics, manufacturing, EV production. If global growth decelerates meaningfully, industrial silver demand softens. Futures markets have mechanisms to manage stress. Position limits, margin adjustments, cash settlement, delivery extensions. Inventory numbers alone do not equal default risk. Price dislocations between exchanges can compress quickly once arbitrage channels reopen or currency shifts occur. Elevated implied volatility can precede sharp downside moves as Azalea's upside breakouts. Silver historically experiences violent corrections. That is documented. Risk management is not optional. It is survival, so what does all this mean? It means silver is not in a simple bull or bear story. It is in a structural tension phase. East versus West pricing divergence. Physical versus paper psychology. Elevated options pricing versus contained spot movement. Declining registered inventories versus historically functional settlement systems. Industrial demand resilience versus macro growth uncertainty. This is the kind of environment where calm charts can precede explosive or they can resolve through slow compression. The next major delivery cycle will provide additional clarity. Watching inventory adjustments, spread movements, and volatility structure will matter more than headline noise, because the real story is not one day's price change. It is system pressure, and system pressure builds quietly before it releases. GSIQ exists for one reason, that hype, verify everything. Check exchange reports, watch open interest, monitor premiums, compare implied volatility to realized moves. Study real yields. The next move in silver will not care about emotion. It will care about liquidity, positioning, and confidence. And confidence can change faster than price. Stay sharp. Stay logical. This is GSIQ. I'll see you in the next update.